It's Wednesday and you're watching FreightWaves Now. I'm your host Anthony Smith, and coming up we're going to have Andrew Cox giving us a shipper update. But first we're going to go to the delightful Donny Gilbert with the carrier update brought to you by PowerFleet. Stay tuned.
Welcome everybody to Wednesday's edition of our Carrier Update. My name is Donny Gilbert. This is brought to you by PowerFleet, and we're going to jump in first thing to look at what's going on in our reefer markets this morning. We'll start out here looking at our reefer outbound tender rejection rate index here. The blue line is this year, 2020, and the purple line, we're going to compare it to last year. This year so far, we're looking at 12.78% for our tender rejection rates, which, you know, I don't get really excited until you get above 10%. This is a national average, so it's a respectable average. But when comparing to 2019, here you can see we're far below, almost a whole 10% below the 22.25%. So running a little bit low this year, but still a decent tender rejection rate for the first quarter. Jumping down here to my bottom here, we have outbound tender lead times. Now your tender lead times, it's the shipper's response to what is going on to the current market conditions. And as you can see, our tender rejection rates have dropped down for the reefer market, and you can see here over the last several days, our tender lead times are dropping down as well. They are down to 3.99 days. So if you're looking for reefer loads right now, understand the average tender lead time is almost 4 days. So when you're looking for freight in future markets, you need to be looking, you know, almost a week in advance if you really want to find those loads. If you wait for a few days in advance, you may not be able to find all the available loads that you are looking for. So now let's jump over here to our reefer tender rejection rate map. I've put all our markets out here on a map. I love looking at the maps because it kind of helps me see what's going on with current markets and the surrounding markets. Now, before we look at this map, I want you to look down here at the very bottom and look at our legend. And pay close attention to the legend, because you can see these very light shades of blue. That's 12.33%. So just because there's not too much color in this map does not mean the tender rejection rates are low. Always look at our legend. The reason the legend is so spread out is because we have some markets that are near 55% and other markets that are near 0%. So as we run through here right quick, starting on the West Coast, we have markets in Washington, Oregon, Idaho, and Utah. These are our strong markets on the West Coast. Of course, we bounce around through. We have some through the Midwest here, running through Iowa, Nebraska. Our hottest markets right now is Little Rock, Arkansas, and the Memphis. And as we roll over here through the Midwest, we have some northeastern Indiana and northwest Iowa markets, North Carolina, and a little bit of shading here through some of the markets in the New York area. Down here, Houston pokes out here just a little bit. It's climbing up in tender rejection rates. But as we look at these tender rejection rates, that tells us that spot market rates are climbing in those markets, but we also need some volume. So I also like to take this map here and look at it. I'll bring it up here just a little bit bigger. I like taking our reefer tender rejection rates and adding our 3D images that has our volumes as well. We'll start here on the northeastern. You see our markets in New York. While they are shaded very lightly, they do have a lot of volumes moving through these markets. Move down here in blue here, North Carolina. Some volumes not as big as some of the other markets, but you see the volumes are moving out of the Charlotte, and about half of that we're moving out of the Raleigh, North Carolina market. Indianapolis, Atlanta, Lakeland, Florida. You see these markets have a lot of volumes right now, but rates are low. So these is not necessarily bad. The rates are, you know, still right around what we would call the contracted rates for these markets. So if you're a reefer carrier and you need to keep your trucks rolling, these are some of the bigger markets that you can run your trucks into. Keep your drivers rolling. You're not going to have great rates, but they're still going to be contracted rates, which most carriers run 90% of the time. So they're not necessarily bad markets, but here's where a lot of your reefer freight is located, moving out of these markets over here in Joliet as well. Now, if you're looking for the markets that are paying a little bit better, we do have Little Rock, Arkansas, and Memphis. Memphis is smaller right now than Little Rock, but both of these have tender rejection rates up and over 50% right now. So only half or less than half of the freight is being accepted in those markets at contracted rates. So that's telling us right now that spot market rates are pushed very high compared to the contracted rates in those markets. So aim your trucks here towards the middle, or even up here into Iowa and Nebraska. These have a lot smaller volumes, but the tender rejection rates are elevated in these markets. Coming over here towards the southwest, Dallas, Fort Worth, a lot of freight in this market, a little bit less in the Houston market, but the rates are a little bit stronger in the Houston market right now. On the West Coast, all the way out here, we see Southern California, Phoenix, Arizona, lots of volumes right now for reefer freight, but the rates again are very low, right around your contract rates in these markets. Bounce over here to Salt Lake City, one of my favorite markets. We see a lot of volumes coming out of Salt Lake City, a lot of volumes coming out of Idaho, and they also have elevated tender rejection rates. So these are very, very good markets to send your trucks to right now. Now let's take some of these markets that are shaded a little bit, that were lightly shaded, and let's kind of see what's going on in these markets. Indianapolis, we talked about 11.83% tender rejection rate. That's a very strong tender rejection rate. I love it when they get above 10%. So a little bit of volatility in this market. In the Northeast, we have Allentown, PA, 11.5%. Another market that has very high tender rejection rates, but the Northeast is also known for very low contracted rate for their outbound freight. So coming from the Allentown market, if you have loads that are going up further into the Northeast, these rates are going to be strong. They're going to be a lot higher. But if they're going from Allentown into the Midwest to, let's say, Chicago, Indianapolis, those rates are still going to be fairly low for your reefer freight. Fresno, California, 4.51%. A lot of volumes there in the Fresno market, yet the rates are in an area that are right in the range of our contracted rates. Lakeland, Florida, again, 2.48%. Now, being below 3%, that's going to tell me that your spot rates are actually below contracted rates. So if you run into the Lakeland market, you need to understand that you need to get your money running into this market, because when you're leaving this market, it's going to be a very cheap rate. It's going to be below your contracted rates. You might actually lose money getting your truck out of the Lakeland market, but there are a lot of volumes. So not a bad market to run to because of the volumes. Just make your money on the way into the market, and you're going to get a cheap rate coming out of the market. Last but not least, Atlanta. Atlanta is 6.8%. So you're kind of on maybe a little bit of the higher end of the contracted rates, but still a relatively low rate, but there's lots of volumes in the Atlanta market. So still not a bad market to run to. Just don't expect a super great rate leaving the Atlanta market. Atlanta has really struggled this year. Atlanta has flipped really from a head haul market in 2018 to more of a backhaul type market through 2019 and so far through the 2020 year. Let's jump into some of our bigger markets that I was favoring. Salt Lake City. Volumes are growing, 59.32 index points for the volume, so a fairly size, and that is volumes for reefer freight. Tender rejection rates have dropped down just a little bit. They are at 21.75%. So rates are dropping slightly, but still a very healthy tender rejection rate at 21.75%. Given the amount of volume and the tender rejection rate, I highly advise this is a good market to run your truck to. Jumping into the Memphis market. Now Memphis has volumes at 15.50. These volumes are a lot smaller than your normal markets, but we have tender rejection rates that are almost 55%. So pretty much around 45% of the loads are being accepted at contracted rates. That's very low. That's telling us right now that our tender rejection rates are telling us that our spot market rates are well above the contracted rates, and that capacity is very tight in that market. Now this market being backed up against our Little Rock market, that's also around over 50% for tender rejection rates. That really means capacity is going to be tightening in that market, because some of your surrounding markets are not going to be able to give their trucks up to the Memphis market. And with I-40 running through there, this could really have an effect on both the Little Rock and the Memphis markets. Last but not least, jumping over to Charlotte, North Carolina. Again, we have our tender volumes at 18.88 index points, so it's a little bit bigger than the Memphis market, but our tender rejection rates are down to almost about 21%. So again, well above contracted rates. Capacity tightening in this market. Raleigh next to it is also tight, so there's not much relief from surrounding markets. So this is a good market if you are able to get a load into the Charlotte market in your reefer carrier. Not a bad market to run into, and they have some volumes. But remember, tender lead times are about 4 days out. So once you book these loads into these markets, you need to start searching for your next load. Do not wait till your truck arrives in that market. Now, before I let you go, I want to talk about a few weather events that are currently happening. We do have snow kind of moving through the Midwest and up into the Northeast, and we have snow that's going to be crossing I-70 between the Kansas City and the St. Louis markets in there. And I-70, of course, is a major corridor for the Western markets. So be sure and check out these snow weather events that are going on right now. Route your trucks around these, keep them safe, and that'll do it for your Wednesday edition. Thank you.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Welcome to your Shipper Update. I'm here with Andrew Cox. Andrew, what do you have for us today?
Tony, today we got the new unemployment report that came out last Friday for the month of January. So we did have unemployment tick up a little bit to 3.6 from 3.5. But again, we are near 50-year lows. This is a chart back to 1950. You can see that we're near the bottom here, peak towards a bottom here towards 1968, but near 50-year lows. And it did tick up, but I don't think we should think that as a bad thing. Our labor force participation increased. I think more people are entering the market, and the unemployment ticked up a bit because they didn't find work immediately, but that shouldn't be taken as a bad sign.
Right. So as you mentioned, a big part of it is that participation rate. A lot of people don't consider that when they're looking at the unemployment numbers initially, but that's the kind of the underlying trend to kind of also watch as well, right? The participation rate, because the employment number is only those that are looking for work, right?
Right, correct. So yeah, the labor force participation going up, I think it was 0.2%. That's a big number, and it's just good for the overall economy. We can jump into a little bit of the report itself, into a couple of the components there. Overall, again, we added 225,000 jobs. That's a really strong clip. I think estimates were something like 165,000 jobs, so much above that. And we jump into construction, which I was happy to see another month of added jobs. 44,000 jobs added. This in part because of the warmer weather across the country, but also because of the lower interest rates and the demand for new housing. This is a good thing for the overall economy, but it's also a really good thing for all the manufacturers and our shippers out there that are building consumer goods in the home. Transportation and warehousing also added a healthy clip, added 28,000 jobs, the majority of which did come in warehouse stocking and in courier delivery. But trucking itself did add a little over 3,000 jobs. And then lastly, I've got manufacturing, and this shouldn't come as a surprise. We talked about the PMI, I think last week on a shipper update, and that's the Purchasing Managers Index. It's a diffusion index that helps us gauge the manufacturing economy, and one of the only components there that wasn't expanding was employment. So seeing it shed 12,000 jobs doesn't come as much as a surprise.
Right, and so breaking this down, construction, definitely a positive that, as you mentioned, one of the headwinds that we had with construction was that there wasn't enough skilled labor to really kind of satisfy the demand for homes. So definitely seeing that there's been some added jobs there, a huge plus. Transportation and warehousing, I'm sure that's going to be a nice consistent trend as we see more and more warehousing pop up throughout the country. Shippers want to get closer and closer to the final consumer. But as you mentioned, manufacturing still having a rough go at it, right?
Yeah, that's precisely right. We had the PMI expand for the first time in 6 or 7 months in January, which is a good sign, but our employment is still down. And this is a lot in part with the Chinese trade war. It kind of put a dent into our manufacturing economy and manufacturing employment over the last, really over the last year, and it hasn't fully recovered. Our exports are still down, even though the trade deal was signed. We're not exporting as much as we would. And then on top of all of this negative news is the looming coronavirus that's shutting down Chinese economy almost completely. So, they're our biggest trade partner. Manufacturing's going to have a rough go at it, at least for the next couple months. We may even get PMI expanding again in February or March, but it's going to be a slow churn upwards.
Gotcha. Andrew, thank you so much for that update.
Yes, sir.
And thank you so much for tuning in. This is going to do it for this Wednesday edition of FreightWaves Now. But if you haven't already, check out our FreightWaves TV app. We're always posting around the clock on all your favorite streaming platforms, including Apple TV. And for all my fellow Android users, we have you covered there as well. Thank you so much for tuning in, and we'll see you on the next episode.
Is the trade war back on?
Trade war.
Trade war, full-blown trade war.
15% tariffs on $112 billion worth of goods.
Hours earlier, China announced tariffs of 5% and 10% on U.S. products.